Hey, how you doing? And welcome to Buy or Sell. I'm Ally Selby, and today we're sitting down with Armina Rosenberg. She's a co-founder and co-portfolio manager at Minotaur Capital. Minotaur is really leading the charge in Australia when it comes to AI-powered fundamental investing. And today we're going to be learning about the stocks that Arms is buying or selling today, as well as some tips on how you could use AI yourself to supercharge your investments. Now, I should say, in total transparency, I actually do work with Arms at Minotaur Capital. I left a career behind in journalism to join the team. I was just so completely blown away by the technology that they developed and their mission to revolutionise investments with AI that I had to join the team. So with that all said, Arms, thank you so much for joining us today on Buy or Sell. Really excited to feature you on the show.
Yeah, I'm excited to be here.
Tell us a little bit about Minotaur Capital. How are you guys using AI in your investment process?
So we use AI in every step of the fundamental investing process. And, when Thomas and I kind of decided to found Minotaur, we thought to ourselves, the world does not need another fund manager, right? There's a dime a dozen out there. So if we are going to do this, we have to have something that properly differentiates us. And we're very lucky, as you know, Thomas is a bit of a secret weapon or a unicorn in that he has these amazing abilities to pick stocks and be a fund manager, but also this incredible ability to build software. So we built our own internal use only proprietary software. It's called Taurient, which is a combination of Minotaur and orientation because it tells us where to look and where to go to look for stocks. And Taurient powers, the entire process for us. So that's everything from idea generation to a quick view of the company and what it does, its revenue and earnings drivers and whether it's worth doing more work on, to that deeper fundamental research, to ongoing monitoring. We now use agents to monitor our positions in our portfolio. So it's definitely, I think, pushed further into the research process that we've seen. And does everything for us. Kind of replaces, to an extent, the need for, junior analysts or investment analysts.
I feel like a lot of listeners will be using ChatGPT themselves or different LLMs to do research or, instead of Google. Can you explain what an agent is for people who don't know?
I think with large language models, you can either have a workflow or you can have an agent. So a workflow is like a recipe. It's basically a set of steps that you can follow and then you get a nice cake or whatever you're making at the end, right? An agent is more like a secretary or a personal assistant. So if you said to your secretary or personal assistant, can you make me a cake? They can go out and find the ingredients and decide what to use and what to buy and where to go to buy it, those sorts of things. That's the difference between having an agent and a workflow.
Okay, moving on from AI itself to AI as an investment opportunity. We've obviously seen AI stocks do exceptionally well this year. There are some market commentators who are worried we are in an AI bubble.
Yeah.
What do you think? We did see some of the mega caps report last week. What are they saying?
Yeah, it's a tough debate. I think after 3 years of strong returns and lots of earnings growth, I can understand why investors are feeling worried about the next correction. That being said, I think an interesting data point is that in the profitless.com era, we actually saw a 266% rise in the S&P.
Wow.
We're actually only at 85% rally. So, and that's with AI companies actually generating earnings growth and supported by fundamentals, I think, a lot more than the dot-com boom. So I think, there's some evidence to say we're early in the innings on the market rise. All the AI CapEx data points from the mega and hyperscalers and the mega cap companies last week were very bullish. So, you had the likes of Microsoft, Meta, Google, and Amazon. They all raised their AI CapEx guidance. The NVIDIA CEO is talking about spending $500 billion on Blackwell and Rubin chips over the next year. Google Cloud sold out of TPUs and there's strong demand, and major customers like Anthropic, OpenAI, and Meta are just coming online. So there's plenty of data points. I think there's 6 of the top spenders. So you're talking Amazon, Google, Meta, Microsoft, Oracle, and CoreWeave. They're now saying they're going to spend $700 billion by 2027.
It's an unimaginable amount of money.
Yeah.
It's just insane.
It sounds like a lot, but then if you think of AI like a game of cricket, and I know we're super sporty people people, you two.
Yeah, look at our muscles. Just super sporty.
Like, there's no shortage of data points to show that we're actually super early in the innings here. So an example is the CEO of Google, Sundar Pichai. He talked about there's 150 Google Cloud customers that each processed approximately 1 trillion of tokens each with Gemini models on a wide range of applications. Now, that sounds like a lot of tokens. That's actually only like less than $1 million per enterprise customer on token usage and annual revenue. So we're talking 150 million in annual revenue for Google Cloud. That's actually only 0.3% of the revenue that Google Cloud is doing today. So, super, super early. I do have regard for some of the circularity arguments we've seen and, like who's paying who and all kind of going around in a circle. And I know that a lot of it is being financed with debt, so that is a bit of a concern. But having said that, you and I know better than most, I'd say, we're kind of doing proper primary research because we're using AI in everything we do.
Yeah.
And I can see it definitely, us definitely 1,000xing our usage of AI in the next, little while even. If you look at earnings season, it showed how AI agents are moving from experiments to revenue lines, like Amazon, Microsoft, and Meta all talked about how they're getting software doing things rather than just answering questions. So, yeah, I could see arguments for and against. I think where the debate comes in is in the next 2 to 3 years, it's hard to see how adoption occurs or accelerates and how that spreads out. So maybe we're, over our skis right now, but it's kind of hard to say.
Yeah, 100%. Okay, so if not AI mega caps, where are you finding the most opportunity right now? I know you look for companies that could double in 3 years or 10x in 10. Are there any 5-baggers or 10-baggers that you think maybe the market doesn't really know about that they should cotton on to?
Yeah, it does feel like and the only thing that people can talk about right now is AI and whether this continuation of US exceptionalism is going to happen. Don't get me wrong. Obviously, us more than most knows how much AI is a big driver of what's going on in the world and a big driver of markets. But what I actually think is that there's some really interesting opportunities in not AI, not the US. And one of the beauties of using Torian is that it does allow us to search the world wide and vast and see opportunities elsewhere. So I want to do something different and talk about some stocks that are not in the US and are potentially more under the radar that your audience has never heard of. We've found there's sometimes better opportunities in other markets that play on the same global thematics and themes that you see in the US, but at better valuations. So the first stock I want to talk about is CD Projekt. What is CD Projekt? It is a Polish game developer. It develops the Cyberpunk 2077 and Witcher games. And CD Projekt is really interesting, or actually game studios are really interesting generally because I think a lot of investors overlook them because the accounting can be a bit complicated. If you think about developing a game, you have all this cost up front and then your revenue and earnings are earned over the life cycle of the game. So it can kind of be hard to see what margins or what returns they're actually making. The way that we deal with that is we look at EBIT margins over 5 years. And on that metric, CD Projekt is actually the most profitable game developer in the world.
Wow,
listed.
More than EA Games.
Yeah, so they do 39% EBIT margins, and that's better than Capcom, better than Nexon, and better than Electronic Arts, as you said. And so until recently, it was doing these amazing earnings, but that profitability, it was really hard to kind of translate back into reinvestment because if you think about it, you can't double the CapEx budget of a game and double the revenues. It just doesn't work like that. So what they've actually done is change. So since 2022, they've gone to dual track development. So they're now developing 2 games at the same time. So you've got The Witcher 4 and Cyberpunk 2 being made in parallel. And then they've layered on smaller projects like The Witcher 1. There's a new IP called Hader. There's a multi-series title called Sirius. So now we're going to 5 games instead of where they were just doing 1. And so that kind of transforms the company from being this sort of feast or famine hit maker to a more steady content maker.
Sounds really interesting. I know that CD Projekt's trading on around 80 times forward earnings for FY26. So feels like shares are pricing in almost near perfect execution of those upcoming titles. Are there any risks that you think investors should be aware of?
I actually don't think it's pricing in perfection at all. I think what that FY26 multiple misses is that it kind of goes back to that lumpiness we were talking about with the cycle. So FY26 will actually be their lowest earnings year over the last 5 years before The Witcher 4 is expected to hit in FY27. And FY27 is when you see that benefit of the dual track development coming through. So the business has historically generated like 300 to 400 million Polish zloty in a year where they don't have any releases. And then that spikes to $1 billion in a year where they have a big release. So what I think is when that dual track development begins, you'll see $1 billion become the norm of earnings in any given year. So, I think that the key risk here is execution, but the bar is pretty low. Like if management executes, I think the disconnect between CD Projekt and other sort of top tier players like your Take-Two Interactives, which makes, Grand Theft Auto and the like, I think that disconnect is going to close. So if you look
at like the market cap disconnect?
Yeah. So if you look at the valuation gap between the two, CD Projekt has a market cap of about US $7 billion and Take-Two Interactive is like over $40 billion. And they have lower margins and I think less like releases coming through. So I do see a world where I think that it can catch up to the likes of Take-Two in terms of market cap.
Wow. Okay. I know your next stock is a Korean company. We have seen fried chicken or chicken stocks like surge in Korea recently when Nvidia's CEO was seen chowing down on fried chicken over the weekend. Is it a fried chicken company by any chance?
No, it's not. Maybe it should be. Maybe we should look into that. Korea does have a tendency to have food and beverage companies go viral after people start eating their stuff.
Yeah.
But sadly, no, this is a lot more boring. Boring in terms of what it is in the business, but ritzy and sexy in terms of the 5-bagger ability that it has to offer investors.
Love that.
So the company is called Coway. It's Korea's undisputed leader in environmental home appliances, so things like water and air purifiers. And they use a subscription rental model. So that delivers sort of sticky utility-like cash flows. They have amazing return on equity of like 18 to 20%. And if you look at revenue and earnings over the last 4 years, I think revenue's been growing at like 7%, earnings at like 9%, and they've had operating margins at 18%. So they have this proven track record for just being this steady grower, I would say. I actually think that that's about to accelerate, so the next leg should be faster because they are expanding internationally and doing that really well.
Taking on Dyson's air purifiers, maybe.
I think that there is a structural trend like towards, purifiers generally. I think people have gotten really cognizant of the importance of hygiene in a post-COVID world. And then you're seeing the rise of middle class and urbanization across the world, but particularly in Asia, which helps that as well. So Malaysia's become their second growth engine. It's 27% of the group's revenues, but they also have Thailand, which is scaling quickly. They've got early footprint in Indonesia and Vietnam and the US.
Wow.
So yeah, I think it's a real grower. You've seen net rental additions grow by like 24% year on year in the last quarter, and that's a good forward indication of forward revenue as well. So yeah, I think it's really exciting. I think the other interesting thing about it is it trades on a really undemanding multiples. I think it's on like 10 to 12 times earnings.
Wow.
Yeah, very cheap. I think part of that is because Korea gets overlooked. I think you're starting to see investors pay more attention to Korea as a region. The rise of K-pop and Korean cultures definitely helped that.
Yeah, K-pop Demon Hunters, so good.
Amazing. And look, like the K-pop stocks are ones that we've liked in the past. But what I like about this is it is like a sort of steady industrial grower that has some growth optionality around it.
Okay, I know it's a new position for you. You bought into it in late October. Its share price has fallen around 20% since peaking in late July. Do you feel like there could be some catalysts upcoming that could see that re-rate?
I think the catalysts are just going to be it proving out this execution, particularly overseas, as earnings reports come out. So I don't know if there's going to be like a huge step change or re-rate in multiple, but as it shows that it's accelerating its overseas mix, it's got resilient margins, and that's also helped by a 40% payout policy. So they have dividends and buybacks that go back to shareholders at 40%. I think that we see room for multiple re-rating because of that.
Your next stock is an Italian company. Tell me a little bit about it.
Yeah, Italian. Don't know why I just did that. So it's an energy transition play. I think most people, when they think of energy transition, they think more about the sources, so things like solar and wind and how to play it that way. What people don't really think about enough, I think, is how you transmit energy. So cables are like the highways of energy, and Prysmian's a high-quality grid infrastructure compounder, and it's leveraged to that multi-year electrification energy transition cycle. So, our investment case is based on a couple of things. It's a structurally tight, high-voltage direct current market. So I'm talking subsea cables there, so cables that go, under the sea, transporting energy from one country to another. There's actually not that many companies in the world that can do that. I think there's 3. Wow. They're all listed. And then they acquired a business called Encore Wire recently in the US, and I think that gives them a bit more optionality in broadening their US electrification exposure. And then they've got record multi-year backlog as well, which kind of gives them revenue and earnings visibility. They have like an 19 billion euro backlog.
Wow.
They've put out 2028 targets for, I think, 3 billion euros in revenue and 1.5 billion euros in free cash flow. I actually think they have a track record of being conservative. I think they're being conservative with that. I think they can hit that or get near to that in 2027. On, our numbers, assuming that they can get closer to that, it's on 9 times EV to EBITDA. Their comps usually trade at like 10 to 12 times, so a bit of a multiple re-rate, and I think they're being conservative on earnings.
How is that company impacted by, obviously we will eventually shift towards renewable energy sources, but obviously there has been kind of some pushback from the Trump administration. How is that company impacted by, I guess, I don't know, a lot of disbelievers?
Yeah, I mean, I think it's interesting in that because it's a transition or like a transmission play, it's less impacted by regulatory policy on like solar and wind. So it's more like the nuts and bolts play, which is a good thing. So it doesn't really matter where energy is being developed, whether that is through renewables or other, like even nuclear, you're still going to need cables. So it's actually, I'd say, less impacted by that. In fact, it is a regulation beneficiary in some instances. So tariffs, they actually have competition from low-cost importers. And so tariffs have actually leveled the playing field for them where, they've actually been a beneficiary of tariffs.
You said before there's 2 other players, all 3 are listed. Is there a lot of pricing competition then? It's
interesting because most of the industries they operate in are under oligopolistic or duopolistic structures. So they usually have 1 or 2 competitors in each market. You take the US domestic market, their main competitors are Southwire and Cero there. And on the last earnings call, they described both of them as being rational and disciplined. So I think that oligopolistic structure really helps to keep pricing rational. On the high voltage direct current market, their 2 other competitors are Nexans and NKT. And both those companies, it's actually more about technological execution. I think all 3 of them, they have proven capability to roll out really complex, hard projects, and they're doing it for the country's utility operator. So I think it's more about reputation than pricing in those markets. And then the last is the fiber optics division. Again, technological innovation is the main, selling point there. Their key competitor is Corning, and so it's about developing next generation products like high density compact cables for data centers with the fiber optics division. So the answer simply is no. I think pricing, because of the industry structure, is actually quite resilient.
Okay, cool. We've kind of been on a round the world tour with these stocks, which I really love.
Whistle stop of ex-US stocks.
Do you have anything else that you're buying right now that you'd like to share with everyone?
Yeah, I think the last one should be a fun one. So Miniso, it's a Chinese dollar store retailer that sells low-cost, design-led lifestyle products across toys, beauty, homeware, you name it. And its core value proposition is affordable joy. So tapping into that impulse-driven pop culture market. It offers a lot of products that are tied to an IP. So Sanrio's Hello Kitty is really popular for them. Disney's Lilo and Stitch is really popular. Harry Potter. They sell, a bunch of different products that are tied to those IPs. So a Harry Potter pencil case or a Lilo plush toy, for example. And its unit economics are attractive. They operate a kind of franchise model model. 90% of their stores are operated by partners, and so it's really good returns for the franchisee and really good return on invested capital for Miniso as well. They are aggressively expanding globally, so they've got, I think, 7,500 stores across 100 countries now. Wow. They want to get to 10,000 by 2027. I think there was an article in the South China Morning Post that Torian picked up that said it wants to get to 40,000 eventually. So definitely wants to be a household name. And it's, the stock, despite that strong top line growth and I guess the sort of asset light model, still only trading on like 14 times PE. So I think that's still relatively cheap.
Miniso's main competitor is Mart, which people know from the viral Labubu dolls that took the internet by storm this year. Its share price has fallen around 35% since peaking in, I think it was late August. You've actually been shorting the stock. You've been talking about it with the AFR and other people while you're shorting that company. Do you think it could fall even further?
Well, the reason we went short is it's highly tied to Labubu. So Labubu, which are the cute little plush toys that Lalisa from Blackpink made popular, in case anyone here lives under a rock and doesn't know about it. Labubu is over 35% of Pop Mart's sales, right? And we were tracking prices on reseller websites like StockX, and you could see the reseller prices falling, which is a good indicator of forward demand. The second reason we were short is it was trading at a large premium to Miniso, which we obviously like. So said Miniso's trading on 14 times, Pop Mart traded on 30 times, so well over double, the PE premium. It's fallen to 20 times, so I think that valuation argument is definitely less compelling. Should we close it? Look, I think Labubu prices do continue to fall on the reseller websites, and I haven't seen a huge ability for the company to broaden out its IP base. Having said that, we do really like this sort of niche Asian consumerism or exporting, Asian cute culture to the world trend and thematic.
You see that continuing, that we'll continue to buy plastic bits of, just so much plastic and junk that we're just tying and buying.
But it's so much joy at the same time. Look, I don't know. If my 3.5-year-old daughter is a litmus test at all, she loves all that stuff. And so, I think that it will continue.
Okay. How about on the other side of that? Where is the market getting a little bit too hot? What stocks would you be selling or shorting right now?
Yeah, so on the AI theme, I think that sometimes AI characteristics of companies can get a little bit overhyped. And I feel like that's the case with a company called HeartFlow. So I think you had Jess Farr-Jones on a podcast here talking about Artria, which is a stock we really like too. Just to recap, Artria is an early-stage Australian medical technology company which is commercialising a diagnostics tool for coronary artery disease, or CAD for short. And that's a multi-billion-dollar opportunity. I think that there's, a real opportunity to replace some of the legacy ways of diagnosing CAD with some of these more automated ways. HeartFlow took the reading of scans from, I think, a couple of hours to less than half an hour.
Wow.
So they've done a great job.
They also had a great IPO.
yeah, exactly. Archie is trying to go one better in that they are trying to lessen that, so you now get a result when the patient is still in the room. So automated point of care solution. And I think Artria actually has the superior product offering. If you look at the valuation difference, Artria trades on closer to US $300 million in market cap. HeartFlow's on $3 billion. I think that speaks to Artria being undervalued, but also speaks to HeartFlow being overvalued. Yeah, you said before, HeartFlow had an interesting IPO. What's even more interesting is the brokers who covered that IPO had to come out, I think, with a buy recommendation on HeartFlow. And so their price targets have it priced at a premium to the premium group. So the premium medtech diagnostics company. And I know, being a former sell-side analyst, when you're trying to juice up your price targets, that means it's pretty well overvalued.
Would you be shorting it here then, or do you feel like there's too much momentum behind it?
Yeah, I think it's a bit hard to short right now. I think we're in this AI lifts all boats in the healthcare diagnostics era kind of thing. So I think shorting is hard. And you're right. I think HeartFlow is kind of the incumbent. It has the biggest evidence base. It has Category 1 CPT, which means it's reimbursable. And so we'll keep an eye on it. If valuations remain lofty, we might see if we'll short it at some point. If we could get hard and fast data as well. I know, at Minotaur, we really love alternative data sources. I actually noticed that HeartFlow it did provide a find a provider page, so you could like see how many hospitals have added their product. They've conveniently shut that site down, so we can't collect that data anymore. And it would have been interesting to see how fast hospitals are adopting it. But if we can find an old data source like that, we potentially go short at some point.
At the very top of the podcast, you talked about not being very keen to talk about US stocks. Is there a US stock that you really don't like as well? I know HeartFlow is obviously listed in the US. Is there something else that's very US-y that you don't like right now?
Yes, there's a stock called Booz, Allen Hamilton. We've been shorting it since all the Department of Government Efficiency initiatives came out. I think that was like March of this year. March 2025.
The Doge stuff.
The Doge stuff, yes. So what Booz Allen Hamilton is a consulting company, and 98% of its revenues come from the US government.
Oh, God.
Yes. And they were actually, I think there was a memo written by the US government on here are the top 10 contractors that we think should be under review in terms of how much we spend with them. And Booz Allen Hamilton was on that list. Now, it had a fall just off the back of being on that list, but I think it actually hadn't translated through to revenue and earnings yet. In the last quarter, it did have an earnings downgrade. It is seeing revenue fall off precipitously and earnings. I think it might have further to go on that though. So yes, that's a stock I don't like. And I think consulting companies generally, like AI is a bit of a longer term, larger threat to them because it replaces the need for knowledge workers in those consulting companies.
Wow. So is it uninvestable then?
I think uninvestable is hard given its long sort of duration as a consulting company. I do think that over-reliance on government is going to continue. Our price target is $75. I think it's trading at $85 at the moment, so a little bit further to go. Although that assumes revenue declines of about 5%. They're doing revenue declines much larger than that, so like at 8%. So potentially there's much further downside to come.
You obviously use AI a lot in your investment process. I was hoping you could share some ideas or tips for our listeners today on how they could use AI themselves to like supercharge their own investing process.
Yes, so there's kind of three key things that I like to tell people. Firstly is use more than one large language model. Too many people go, I just rely on ChatGPT. Yeah. But don't forget that every large language model is biased by like their own training data sets. And for ChatGPT, that's a very Western data set, Western mindset. I try to use at least 3 on any given problem that I give something.
Which 3? What are the best 3?
I use ChatGPT, Claude, and Perplexity. Oops. Yeah, so they're the 3 that I mainly use. I think any 3 is like good, but always just use more than one. And it's also important to give them as much context as possible. So that's my second tip is, if you're asking it a specific question, try and feed it data sources like our snapshot report. We feed in the SEC filings. We feed in consensus estimates from Visible Alpha. We feed in popular stock forums like Seeking Alpha, just to make sure
Maybe
it hones down.
just explain what the snapshot report is because people might not know.
So we generate a snapshot report which tells us a quick view of the company and whether it's worth doing more work on or not. So it says things like what the company does, its revenue and earnings drivers, what makes it interesting, if anything, the bull and the bear case, can it double in 3 years or 10x in 10 years, which is our internal rate of return framework that you outlined before. And then is this worth doing more work on? And so that report, we used to get our junior analyst to write that. It would take them 5 days. A senior analyst would usually take a day to write that. I think Torient does it in a matter of minutes now, right?
Yeah, it's like an initiation report that you'd get from a broker like Morgan Stanley.
That's exactly right. And then my third tip, which you know what I'm going to say, Ally, because you know how much I love it, is Prompt Cowboy. So
at this stage, you should be getting paid by Prompt Cowboy.
I feel like I should too. I am not, guys, just to be clear, not being paid by Prompt Cowboy.
It is amazing though. Yeah,
so it's an Aussie startup, and I think their tagline is they turn your lazy prompts into great ones. And they really do. They help you contextualize your prompts. Prompt engineering is a thing for a reason. I think that's another tip, use different prompting techniques, but Prompt Cowboy can help you with those different prompting techniques as well.
100%. Okay, last question for today. I always like to end with a sexy or spicy stock, an amazing growth opportunity for the years ahead. What do you have for us today?
Boy, do I have something exciting for you. I have
something sexy or something spicy, hopefully?
Both. Maybe weird and nichey, I would say as well. It's one of Minotaur's favourite stocks. It's Cover Corporation. So I know you know it well, Ally, but for your audience, let's probably step through what a VTuber is.
Yeah.
So when you stream on Twitch, You can have your camera on, your camera off, or you can use a virtual avatar. So think a cute anime version of us. That would be pretty cute, actually. A cute anime version of us as opposed to our actual face. And VTubers are actually growing faster than other kinds of streaming, and particularly for females. So if you look at the top 10 streamers last quarter, so top 10 female streamers last quarter, 7 out of 10 of them were these VTubers.
Why do you think that is?
I think it's a lot to do with safety. So a lot of streamers, female streamers out there, unfortunately do get attacked.
Yeah, there's a lot of trolls out there.
There's a lot of trolls.
On the YouTubes.
So having effectively a character instead of yourself is a really good way to protect yourself. Having said that, there's a lot of other benefits too. So as a streamer, 95% of your revenue comes from donations or subscriptions to your channel. But if you join Cover Corp, which offers a brand agency called HoloLive, if you join HoloLive, that streaming and donations or subscription and donations, that only becomes like 25% of your revenue. What Cover Corp offers is the ability to merchandise your character, and that's 45% of their revenue. So think plushie toys and posters and mugs and the like. They also help you to put on concerts. And they also help you to secure licensing and sponsorship deals. So some of the big talent of Cover Corp has sponsorships with McDonald's, right?
Wow.
The other reason why you want to join them as an independent VTuber is because you 10 to 20x your audience base on pretty much day one. So you get this huge increase in audience and huge increase in abilities to monetize that audience. So I think they do $3 million per VTuber in revenue. And it's growing quite rapidly, like earnings are growing at like 50%, not this year because it's an investment year, but from about FY27 onwards. So it's only trading on like 16 times FY27. Now, we really like it. I think it speaks to that whole, kind of similar to Miniso, that whole like cute Asian or Asian culture, Asian IP exporting that's happening. We think that there's, further, I guess, revenue streams to come from licensing and content and the like. So yes, Cover Corporation, weird, nichey, spicy, sexy, all the things.
It's obviously big in Japan. Do you think it can get big like in other countries like Australia or the US as well?
Yes, I think so. And I think that's a key part of our sort of investment case. So we think it's growing particularly in the US. It's growing actually 50% revenue growth in offshore markets.
Wow.
So, I think Western society will take a little while to catch up, but Androsine Horowitz put out this amazing report on how anime is just like eating the world. And I think that speaks to, like, a lot of the characters are kind of anime-like characters, right? So I think that speaks to some of the, broader trend that is driving Cover Corp too.
We talked about agents versus workflows at the beginning of the podcast when we were explaining, I guess, the evolution of AI. I know that you have an agent for Cover Corp. Can you explain like what that is and how that works?
Basically, we have a file on all of our stocks, which is called our AI file, and it has a list of instructions of things that we want an AI agent to do. So in the case of Cover Corp, it has an internal company blog, which has a lot of information in it. We ask the AI agent to see if there's a new version or a new update to that blog. We ask it to scour news in English and in Japanese, so which is great because I can't, search in Japanese for the latest developments in the company. We ask it to find things about new concerts or music or anything about their talent. On Monday morning, for example, it flagged that one of their talent has some health issues and that another one of their talent is doing a collaboration on a limited keyboard. So it really keeps us up to date and in the flow of our stocks. And it's effectively like having an investment analyst that is working on one single stock in our portfolio every day, including the weekends, at a fraction of the cost. So that's a really cool thing that we're doing with that agentic functionality at Minotaur.
Okay, well, thank you so much for coming on the show today, Arms. Loved having you here. Thank you for sharing all your ideas.
No worries. Thanks, Ally.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.